Building a profitable company takes decades of precise execution, but when it's time to sell, that carefully constructed value can shatter on the open market. If you own a lower middle market business in California, generating between $2 and $50 million in revenue, you operate in a high-stakes environment. The natural instinct is to sprint to the finish line. You want to list the company, secure a massive initial offer, and cash out while the numbers look good. But there is a brutal difference between the headline valuation you see on a letter of intent and the actual cash that hits your bank account at closing. Buyers often lead with a premium offer, say a $10 million headline valuation. During diligence, deductions start. Unverified add-backs and poorly defined working capital drag the price down. Then operational audits on compliance or concentrated revenue trigger further discounts, destroying your final closing value. Selling a business is an exercise in extreme risk control. Maximizing your payout requires paying a pre-sale premium, investing heavy amounts of time and capital upfront to eliminate the flaws that buyers use to demand a discount. Institutional buyers and their SBA lenders operate on strict skepticism. They assume seller-provided financials are optimistic, and their diligence teams look specifically for discrepancies. Your strongest defense against these price reductions is commissioning a third-party quality of earnings report. This is a heavy lift. A formal quality of earnings analysis will cost tens of thousands of dollars and typically delays your market entry by several months while auditors scrub your books. This table illustrates why that cost is justified. Standard tax return accounting minimizes your tax burden, which lowers your reported EBITDA. Buyers, however, calculate value based on normalized EBITDA. The quality of earnings report meticulously documents the bridge between those two numbers. It justifies adding back one-time legal fees, unusual lender spend, and owner compensation to present the true, recurring cash flow of the business. When you present these independently verified numbers, you remove the buyer's ability to claim uncertainty. Conversely, presenting aggressive, unprovable add-backs on your own destroys your credibility. It signals to the buyer's diligence team that they need to dig deeper into every single line item. The upfront cost of a quality of earnings report functions directly as a mathematical insurance policy. It protects your valuation multiple from being torn apart at the negotiating table. Beyond the financials, operating in California introduces a dense regulatory environment that creates severe friction during an ownership transfer. If institutional buyers or SBA underwriters spot unmitigated compliance exposure, they will freeze the escrow process immediately. This quadrant chart maps out how to prioritize local compliance issues, measuring the effort required to fix them against their potential to kill the deal entirely. Misclassifying employees as independent contractors represents a massive liability. Buyers view this as an unpredictable legal risk that could infect the new entity. Similarly, failing to plan for the non-transferable nature of California sellers' permits and local payroll accounts will completely stall the legal transfer of assets. Running an internal audit on these classifications and permits creates immediate, frustrating administrative work for you and your staff today. But resolving these issues before contacting buyers ensures a clean legal transfer and prevents bank underwriters from pulling their financing at the last minute. Choosing to ignore these administrative chores almost guarantees a delayed closing or a complete collapse of the transaction when the buyer's legal team uncovers the mess. Even with clean financials and a perfect legal structure, underlying flaws in their business model will still repel institutional capital. A severe operational vulnerability is customer concentration, specifically relying on a single client for more than 15% of your total revenue. Buyers view heavy concentration as a fatal risk. They model their offers under the assumption that a massive chunk of future cash flow will disappear if that one client leaves. Mitigating this requires active pre-sale effort. You have to secure long-term, legally transferable contracts with those highly concentrated clients and key vendors. This forces an awkward trade-off. You must initiate sensitive retention conversations with your most important clients long before you are ready to publicly announce a sale. Deal momentum is highly fragile. Operational uncertainties trigger a chain reaction, causing buyers to demand larger escrow holdbacks or aggressive earnouts. Having those difficult conversations early and producing solid contracts shifts the buyer's perspective. They stop viewing the concentration as a fatal flaw and treat it as a managed risk. Providing operational transparency upfront preempts catastrophic renegotiations when the buyer inevitably runs an audit on your customer data. Deciding whether to invest the time and capital into this pre-sale premium depends entirely on your exact timeline to exit. This decision matrix breaks down your exact next steps based on how urgently you want to leave the business. If you are a horizon planner with 12 to 24 months before you need to transition out, your directive is to fix the risk. With a long runway, the return on investment for preparation is overwhelmingly positive. You have the time to commission a quality of earnings report, normalize your EBITDA, and secure those key customer contracts. If you are a fatigued seller who is completely burned out and demands an exit in less than 6 months, your directive changes. You have to frame the risk. Because you cannot fix deep structural issues in 3 weeks, you must aggressively disclose your flaws early in the confidential information memorandum. Framing means proposing clear, legal solutions up front and accepting a lower valuation multiple to keep the buyer moving forward. Whether you have the time to fix risks or are forced to frame them, the singular objective remains identical: eliminate all mid-diligence surprises. The intricate terms of the definitive purchase agreement and the final working capital true-ups dictate your actual wealth, not the idealized numbers on a marketing teaser. Protecting your final payout in California requires rigorous preparation. Eliminate the surprises, and you completely remove a skeptical buyer's leverage to discount your life's work.